People keep attributing words to me that I never spoke, predictions I never made, and narratives I never pushed. It's strange how often that happens now. Almost every time, it leads back to someone running the same format, the same tone, the same thumbnails, hoping that surface-level similarities will make viewers forget one thing that can't be duplicated: real exposure. Skin in the game. When markets move against you, when your reputation is on the line, when your track record is public and searchable, there's no room for theatrics. Some people even go as far as tying my name to individuals I have no connection with at all. Let me be clear, I'm responsible only for what I say, where I say it, and under the handle, the real John, nothing else thing. That distinction matters, because what you're seeing right now across markets isn't entertainment. It isn't speculation dressed up as certainty. One day, silver is supposedly heading to the moon. The next day, it's supposedly collapsing to zero, and somehow both claims are delivered with the same confidence. That's not analysis. That's noise. Here, the goal has always been different. We look at both sides. We look at macro forces and micro mechanics. We look at geopolitics, capital flows, derivatives, physical supply, and uncomfortable data points that contradict the popular thesis. If you're here expecting a cheerleading session, you're in the wrong place. If you're here to understand why markets behave the way they do under stress, then stay with me, because everything that just happened in silver only makes sense when you step back far enough to see the entire system moving at once. Yesterday, a very specific warning was laid out. Not a range of outcomes, not a collection of hypothetical scenarios designed to sound right no matter what happened. One condition, one level. If silver failed to hold a key exponential moving average on an hourly basis near a critical zone, downside acceleration was likely. That level didn't hold. And as I'm speaking now, Western spot prices are sitting dramatically lower than they were just hours earlier. Futures followed. If you're new and thinking this sounds like hindsight, I understand the skepticism. That's healthy. But everything was documented publicly before it happened. No revisions, no deletions. One call, one invalidation point. Markets either respect structure or they don't, and when they don't, it's usually because something much larger is unfolding underneath. What makes this move so important isn't just the price decline itself, it's the speed and the scale. In roughly 80 minutes, close to $1 trillion in market value was erased across precious metals. Gold fell sharply, wiping out hundreds of billions in capitalization. Silver collapsed even harder on a percentage basis, eliminating hundreds of billions more in a window so tight it barely allowed human traders to react. That kind of movement doesn't happen because of a headline. It happens when liquidity is pulled, when leverage is unwound, and when forced selling overrides rational positioning. Zoom out, and the picture gets even clearer. The US dollar surged aggressively, pushing toward levels last seen earlier in the year. European equities were crushed. US equity futures sold off hard across the board. Energy markets exploded in the opposite direction, with natural gas posting gains that would normally take months, not days. In Asia, markets that had been closed suddenly reopened into a reality they hadn't yet priced in, and the result was violent repricing. Entire national markets lost hundreds of billions in a single session, not because fundamentals changed overnight, but because they were finally allowed to reflect them. This is where confusion sets in for most people. On the surface, none of this seems to make sense. The Middle East is more unstable than it has been in years. Energy infrastructure is under direct threat. Shipping routes are compromised, oil risk is rising, and yet silver collapses. The instinctive reaction is to assume manipulation, incompetence, or some hidden conspiracy. But the first layer of explanation is actually mechanical. Silver isn't just a monetary metal. Roughly half of its demand comes from industrial use. Solar panels, electric vehicles, electronics, data centers, defense systems, and infrastructure all depend on silver. When algorithms detect a shock that threatens global growth, industrial demand projections get slashed instantly. Those models don't pause to debate nuance. They sell first and ask questions later. Gold behaves differently because it isn't consumed by factories. It doesn't rely on economic expansion to justify its existence. That's why in every growth scare, the hierarchy is the same. Gold holds best. Silver follows. Then platinum. Then copper. The deeper you go into industrial dependency, the harder the hit. That part is textbook. But textbook explanations don't justify an 11% collapse in barely over an hour. That kind of move requires additional pressure, and that's where things get interesting. Because while Western paper markets were imploding, something very different was happening elsewhere. Prices in Asian physical markets remained significantly higher. Even after the crash, silver was trading at a substantial premium outside the Western futures complex. That disconnect matters. It tells you that this isn't a universal repricing of value. It's a localized liquidation event. When you line up the ratios, the distortion becomes impossible to ignore. The paper gold to silver ratio has blown out to levels that bear no resemblance to reality. In the ground, silver is mined at a fraction of that ratio. In vaults, the ratios are tighter still. In available above-ground supply, the ratio collapses even further. One of these numbers is lying, and historically, it's never been the physical side. At the same time, something quietly disappeared. A major exchange that routinely publishes detailed inventory data simply stopped reporting silver figures during one of the most volatile periods in recent history. Gold data continued. Silver went blank. That doesn't happen by accident. Data doesn't vanish randomly, especially when markets are under stress. When transparency disappears, it's usually because the numbers would raise uncomfortable questions. Add to that a series of signals that most people never look at. Lease rates began creeping higher. Swap structures turned increasingly negative. These aren't headlines. They don't trend on social media. But they matter. Rising lease rates mean it's getting more expensive to borrow physical silver. A negative swap suggests stress in the forward market. In other words, paper prices are falling while physical tightness is increasing. That divergence doesn't resolve quietly. Vault data confirms it. Millions of ounces were withdrawn from major storage facilities in a single day across multiple custodians at once, not transferred, withdrawn. And while some will point to changes in registered inventory as a sign of stability, that argument ignores the full picture. Eligible metal is declining faster than registered metal is increasing. Total inventory continues to fall. That's the number that matters. Meanwhile, exchanges overseas took direct action, suspending multiple groups of trading accounts during the chaos. That tells you positioning had become unstable enough to warrant intervention. Combine that with the inventory data blackout, and you have two separate actions, in two separate markets, both occurring on the same day, both pointing towards stress beneath the surface. Then there's the volatility layer. One firm has quietly become the largest holder of shares in a major silver trust, acquiring an enormous position in a short period of time. This firm isn't known for long-term investing. It's known for options. Massive options. The majority of its portfolio is derivatives-based. The business model thrives on volatility, not stability. Build exposure to the underlying asset, layer derivatives on top, induce movement, and monetize the swing. This pattern has been documented before in multiple jurisdictions across multiple asset classes. In other markets, regulators have already proven similar behavior. Lawsuits have been filed, settlements have been paid, patterns that once seemed coincidental became obvious once they were exposed. Even in crypto, there were periods where sell-offs occurred with such mechanical precision that traders could set their clocks by them. Those patterns didn't stop because they stopped working. They stopped because legal pressure forced them to. Now consider who holds the physical metal backing those trust shares. A bank with a long, well-documented history of precious metals manipulation. One that has already paid massive fines for doing exactly what critics accuse it of doing now. When the custodian and the largest shareholder both carry that history, an 80-minute collapse before a major market open starts to look less like randomness and more like structure. But none of this exists in isolation. During genuine liquidity events, correlations spike toward 1. Everything sells: stocks, bonds, metals. The dollar rallies. Cash becomes king, not because it's valuable, but because it's required to meet margin calls. Forced liquidation doesn't discriminate between good assets and bad ones. It sells what it can, not what it should. That's the environment we're in now. The dollar pushing toward key resistance levels adds fuel to that fire. A stronger dollar puts pressure on all dollar-denominated assets. Oil has managed to resist that pressure, not because it's immune, but because physical supply constraints are overwhelming paper dynamics for the moment, and those constraints are escalating fast. Critical energy infrastructure has been hit. Alternative shipping routes are being targeted, not just the obvious choke points. Major oil fields have been shut down. Production is offline. When tankers can't move, storage fills. When storage fills, production stops. That's not speculation. That's logistics. And it's happening in real time. Warnings have been issued about further attacks. Key facilities are under threat. Diplomatic lines are hardening. Major powers are taking sides, not rhetorically, but operationally. And when leaders openly state that the worst hasn't happened yet, markets have no choice but to listen. This is where honesty matters. Silver did break down technically. The level failed. In a liquidity squeeze, even structurally sound assets get sold. Western mining equities aren't confirming strength seen elsewhere. Divergences like that deserve respect. If the dollar continues higher in the short term, metals could face additional pressure. Those risks are real. But here's what didn't change. Inventory transparency vanished at the worst possible moment. Physical silver continues leaving vaults. Lease rates are rising. Paper ratios are completely detached from physical reality. Mining ratios haven't changed. Vault ratios haven't changed. Physical buyers haven't disappeared. In fact, they're doing the opposite. Public companies are now openly adding physical silver to their treasury strategies, at a scale that would have been unthinkable not long ago. That's the disconnect. Paper prices collapsed. Physical demand did not. Premiums remain. Inventory continues to drain. The signals that matter aren't flashing red. They're flashing warning yellow, telling you that something beneath the surface is tightening, not loosening. So don't watch the price alone. Price is the last thing to tell the truth in a distorted market. Watch the inventory. Watch the premiums. Watch the lease rates. Watch what happens when transparency disappears. Don't take my word for any of this. The data is public, the patterns are documented, and they tell a story that's very different from what a single chart on your screen might suggest. This isn't about hype. It never was. It's about understanding how markets behave when stress reveals their weak points. And right now, silver is sitting exactly at the intersection of monetary fear, industrial dependency, geopolitical escalation, and derivative-driven volatility. That's not a comfortable place to be, but it is an honest one.